You weren't supposed to hear this. While most people are arguing about meme coins, chasing altcoin pumps, and refreshing charts every 10 seconds, nearly $11 billion has quietly flowed into something so boring, so stable, so system-approved that it looks harmless. Tokenized U.S. Treasuries. $10.86 billion, sitting just under the 11 billion mark like it's waiting for permission to cross a line that most retail investors don't even know exists. This isn't hype money. This isn't degenerate leverage. This is institutional capital moving with surgical precision. And when that kind of money moves quietly, you need to pay attention. If you want real financial truths they don't teach, hit subscribe and turn on notifications. You don't want to miss what's coming. Because what's happening here is not just about yield. It's not just about bonds on a blockchain. It's about the digital restructuring of the safest asset class in the world and the slow psychological conditioning of investors into a new financial architecture. Digital treasury products have added $1.9 billion year to date. The sector climbed another 2.51% in just the past 7 days. It now sits at 10.86 billion, inches from that 11 billion milestone. And the growth has been consistent, measured, relentless, almost procedural. But here's the part nobody is saying out loud. When institutions move into tokenized treasuries, they are not chasing returns. The average 7-day annual percentage yield across the sector just dropped to 2.66%, down nearly 17% from the prior week. That's not exciting. That's not explosive. So why is capital still rotating in? Because yield isn't the real play. Control is. 65,058 holders now sit inside these tokenized treasury products. That number actually dipped slightly over the week. Fewer holders, more money. Think about that. Concentration increases while participation flattens. That's a pattern you see when larger entities absorb supply while retail loses interest. It's the same accumulation model whales have used for decades. Suppress excitement, lower volatility, let attention drift, accumulate in silence. Ethereum still dominates the landscape, hosting $5.5 billion of the total value. BNB chain follows with $2.1 billion. Solana carries nearly $900 million. Stellar, $829 million. Smaller but still significant slices spread across Aptos, XRP Ledger, Avalanche C-Chain, Arbitrum, and others. This isn't random distribution. This is infrastructure testing. Institutions are mapping liquidity pathways across multiple chains, stress testing settlement layers, measuring cost efficiency, observing user behavior. They're not just buying yield, they're building rails. Now look at the inflows. BlackRock's BUIDL fund led the month with $460 million in net inflows. Ondo's USDY pulled in $302 million. Circle's USYC added $251 million. Superstate's USTB brought in $148 million. Centrifuge's JTRSY secured another $103 million. Smaller flows stacked quietly from Spico, Libera, and Zeconomy, brick by brick, controlled pace, no frenzy, no headline screaming moon. But here's the psychological trap. When retail sees stability, they see boredom. When institutions see stability, they see foundation. This is the difference between gamblers and architects. On the outflow side, Fidelity's FDIT dropped $36 million. Ondo's OUSG logged $45 million in redemptions. Minor rotations, not panic, not collapse, just repositioning. 64 treasury products now exist in total. BlackRock's BUIDL sits at the top with $2.17 billion. Circle's USYC follows at $1.71 billion. Ondo's USDY holds $1.28 billion. Franklin Templeton's Benji, nearly $900 million. Superstate's USTB, $771 million. WisdomTree's WTGXX, $730 million. Ondo's OUSG, close behind. Janus Henderson's JTRSY. China AMC's Kumiu. Spico's USTBL. Fidelity's FDIT. This is not experimental anymore. This is layered institutional participation across asset managers who collectively oversee trillions in traditional markets. And they are not here for the 2.66% yield. They are here because tokenization transforms treasuries into programmable collateral. Let that sink in. Traditional treasuries are static instruments. Tokenized treasuries are liquid building blocks. They can be used in DeFi protocols, collateralized instantly, settled 24/7, transferred globally without legacy banking rails. This is not about replacing bonds. It's about upgrading them. And once the safest asset in the world becomes digitally native, the entire liquidity structure changes. Now zoom out. Governments are drowning in debt. Currency debasement is not a conspiracy theory, it's arithmetic. Inflation quietly erodes purchasing power while media narratives distract with surface-level volatility. Retail investors chase upside because they're afraid of missing out. Institutions accumulate infrastructure because they're afraid of losing control. Tokenized treasuries sit at the intersection of fear and control. They offer stability inside crypto's volatility and digital efficiency inside traditional finance's rigidity. They are the bridge, and bridges are strategic assets. Here's where it gets darker. When liquidity tightens globally, capital doesn't disappear. It consolidates. It moves towards safety. But now safety is becoming programmable. Imagine a future where massive pools of institutional capital can move into tokenized government debt instantly during a risk-off event. No settlement delays, no cross-border friction, just immediate rotation. That kind of agility amplifies elite positioning during crashes. Retail, meanwhile, reacts emotionally. Fear triggers selling. Greed triggers buying tops. Media narratives amplify both. You've seen it before. Bull markets are fueled by stories of revolution. Bear markets are framed as catastrophe. But underneath the emotional theater, liquidity flows into predictable safe havens. What changes when those safe havens live on-chain? It means capital flight becomes faster. It means asset repricing cycles compress. It means insiders with early access to liquidity data can anticipate shifts before price charts reflect them. The battlefield is no longer just price, it's speed. $10.86 billion may sound small compared to traditional bond markets, but early stages always look insignificant. Remember when stablecoins were dismissed? Now they are core plumbing for crypto liquidity. Tokenized treasuries are following the same curve, but with institutional fingerprints all over them. The average yield dropping nearly 17% week over week didn't stop inflows. That tells you something critical. Investors entering now are not yield sensitive. They are structure sensitive. They want exposure to the mechanism, not the percentage. They are positioning for a future where real-world assets become the collateral backbone of decentralized finance. And here's the twist most people will miss. As tokenized treasuries grow, they blur the line between traditional finance and crypto. That reduces perceived risk for large allocators, pension funds, endowments, sovereign wealth. Once the safest instrument in the world is normalized on-chain, everything else becomes easier to justify. This is how silent wealth transfers happen. Not through dramatic crashes, through gradual normalization. Retail investors are conditioned to believe that volatility equals opportunity, but institutions often build fortunes in the quiet phases. Accumulation during boredom, expansion during confusion, exit during euphoria. Right now, boredom is the cover. 65,000 holders is not mass adoption. It's controlled distribution. Ethereum's 5.5 billion dominance shows where primary settlement confidence lies, but secondary chains gaining share reveal optionality. This is portfolio diversification at the infrastructure level. Ask yourself why BlackRock is comfortable leading with $460 million in net inflows, why Circle's USYC holds $1.71 billion, why Franklin Templeton is participating. These are not crypto-native degens. These are legacy giants adapting to a shifting monetary landscape because they understand something most people don't. The next phase of financial power is not about replacing the dollar. It's about digitizing it so completely that control becomes frictionless. Tokenized treasuries are dollar-denominated government debt wrapped in blockchain rails. They maintain faith in the underlying system while upgrading its speed and composability. That's not rebellion. That's reinforcement. And reinforcement during uncertain macro cycles is strategic. Inflation may cool temporarily, rates may fluctuate, media will spin every data point into a narrative of crisis or recovery. But underneath it all, infrastructure keeps building. When the sector crosses 11 billion, headlines will call it a milestone, but insiders will treat it as a checkpoint. The real milestone will be when these instruments integrate seamlessly into lending markets, derivatives, collateral frameworks, and cross-border settlements at scale. When liquidity pools use tokenized treasuries as base collateral instead of volatile assets. When stablecoin reserves increasingly mirror these digital bonds. That's when the silent reset accelerates. The human mind is the real battlefield here. Most investors anchor to price charts. They obsess over candles. But structural shifts happen off-chart. They happen in custody agreements, regulatory clarity, institutional partnerships, back-end integrations. Fear keeps retail reactive. Greed keeps them impulsive. Both states are exploitable. Institutions, on the other hand, operate on longer cycles. They think in decades, not days. They see currency debasement trends. They see demographic pressures. They see debt trajectories. And they prepare escape valves before panic arrives. Tokenized treasuries function as one of those valves. In a liquidity crunch, being able to move billions into blockchain-based government debt instantly provides optionality. Optionality equals power. Power equals control over timing. And timing is everything during asset repricing events. This isn't about conspiracy. It's about incentives. BlackRock's BUIDL at $2.17 billion isn't an experiment anymore. It's proof of concept scaling. Circle's USYC at $1.71 billion reinforces stablecoin synergy. Ondo's USDY at $1.28 billion signals structured demand. The numbers aren't astronomical yet, but they don't need to be. What matters is trajectory. Growth has remained consistent since last year's wave of demand gathered momentum. The cadence hasn't meaningfully cooled. That tells you adoption isn't hype-driven. It's policy-aligned, infrastructure-supported, quietly encouraged. When something grows steadily without retail frenzy, it often means the groundwork is being laid for institutional dominance. And here's the warning. If tokenized treasuries become the default safe haven within crypto, then during the next market panic, capital could rotate internally instead of exiting the ecosystem entirely. That stabilizes the broader digital asset market. It also concentrates influence among those controlling the largest treasury pools. Control the collateral, and you influence the leverage. Leverage drives markets. So when you hear 10.86 billion approaching 11 billion, don't dismiss it as a footnote. See it as a signal that the boundary between traditional fixed income and decentralized finance is dissolving. Most people will ignore this because it's not flashy. It doesn't promise overnight wealth. It doesn't trend on social media. But foundations never trend. They just hold everything up. The real question is not whether the sector crosses 11 billion. It will. The question is what happens when it hits 20, 50, 100. At scale, tokenized government debt becomes programmable monetary policy infrastructure. That's not dramatic. That's transformative. And transformation rarely announces itself with fireworks. It arrives quietly, disguised as incremental growth. 2.51% weekly increases, 1.9 billion year-to-date additions, slight dips in holder counts masking concentration, yield compression alongside capital inflows. These are the fingerprints of strategic positioning. So here's the choice in front of you. You can keep chasing volatility, reacting to headlines, letting fear and greed dictate your decisions. Or you can study the infrastructure shifts happening beneath the noise, because when the next liquidity shock hits, when asset prices reprice violently, when narratives flip overnight, those positioned inside programmable safe havens will have options. Those outside will have reactions, and reactions are expensive. The climb toward 11 billion is procedural, almost inevitable. But inevitability doesn't mean irrelevance. It means preparation. Preparation for a world where money moves at the speed of code, where government debt settles on chain, where collateral is composable, where institutional capital can pivot in seconds. If that future feels distant, remember that stablecoins once felt experimental. Now they move hundreds of billions daily. This is how systems evolve. Gradually, then suddenly. The 11 billion mark will be checked off like a formality. Media will call it growth. Analysts will publish charts. But the real story will remain between the lines. The safest asset in the world is being quietly rewired. And rewiring the safest asset rewires everything connected to it. Most people won't understand this until it's obvious, until tokenized real-world assets dominate DeFi collateral, until liquidity cycles accelerate, until capital flight during crises happens at digital speed. By then, positioning will already be set. So ask yourself this. When the next market panic hits and billions rotate in seconds into on-chain government debt, will you understand what's happening, or will you just see prices moving and feel fear? Because this isn't just about bonds. It's about who controls liquidity when the music stops, and the ones building the rails rarely lose their seat. The sector is at 10.86 billion today. Tomorrow it crosses 11. Next year, maybe multiples of that. Each dollar added isn't just capital. It's infrastructure, it's permission, it's normalization. It's the quiet digital extension of traditional fixed income exposure into a programmable financial universe. That doesn't sound dramatic, but power rarely does. The system isn't collapsing, it's upgrading. And upgrades favor those who see them early. Remember this, the loudest moves in markets attract attention. The most important moves attract almost none. Tokenized treasuries are the latter. So here's my question for you. Do you think this growth is just a convenience play, or is it the foundation of a deeper financial reset? Drop your answer in the comments. I read them. Send this to someone who needs to hear it before the next liquidity cycle flips the script. And if you want to stay ahead of the silent shifts shaping money and power, subscribe now and turn on notifications. Because by the time everyone is talking about it, the real opportunity will already be gone.